it like to be a growth investor right now, especially in the middle of a pandemic?
Yeah, I think it's always a great time to be a growth investor. I think especially in this pandemic, it's excellent because where you see is in this environment, you see it a little bit in the S&P 500. If you disaggregate it, the FANG Plus stocks are up 50% year to date, whereas in equal weighted measure, it's actually down 10%. And so I think there's clearly a flight to quality and a really rewarding of growth. And so Oatly and our previous investment in Bumble, these are examples that are entirely consistent with where Blackstone has been spending its time in focusing on industry leaders with world-class management teams with big global ambitions that are well suited to leverage our global network.
We've definitely seen a flight to growth, that's for sure. But going long U.S. tech and growth is seen as the most crowded trade, according to a new Bank of America survey of fund managers. And we've heard that refrain for quite some time, that it is a crowded trade and that people are looking for some sort of reckoning there. Does that concern you as you try and figure out some sort of price discovery for the assets in which you are negotiating with?
I think as a general matter, growth companies will always command a premium, right? In general, there's an inherent survivor bias for growth companies. And so you'll always be on the full side of a fair price. I think the way we try to solve that is through more of our portfolio construction. I think all too often, growth equity investors in general will invest in a massive number of companies where it's effectively an index fund. If you're investing in 20 or 25 companies per year, you can't do anything other than be subject to the tailwinds at the surface. For micro investors, we're picking 3 or 4 situations globally where we believe we have a unique ability to add value. And so regardless of what's happening at the surface, we can be insulated from that. And we've tried to solve our exposures to excessive prices more by being micro investors.
As you look at the market for potential exits, the IPO market has seen quite a significant pipeline of deals recently. We've got the parent company of Quicken Loans coming down the pike. We've got Rackspace, Palantir, a pretty full schedule for a summer in the middle of a pandemic. As you look at kind of what's going on with IPOs, as you look at what's going on in the aftermarket, where you see stocks doubling in their first day, alongside some of the uncertainty, how do you kind of assess that market as you continue to pursue deals and look for potential exits in the future?
Yeah, and in many ways, I draw encouragement from it. This is a situation in which the market is celebrating growth. There again, as I mentioned earlier, there's a survivor bias for these companies. And this is exactly the moment in time in which the strong tend to get stronger. And I think if you look over history, there's an innovation bias in growth equity where you will find yourself on the right side of history. And I think a lot of these recent IPOs are good examples of that.
John, it's David Faber. You said earlier you look for opportunities where you have a unique ability to add value, given you're not approaching this like an S&P 500 index. Give me an example of something that would sort of give us a sense for how you add value in this fund with your investments in a unique way.
Sure. Well, the first comes down to our portfolio construction. Again, it's a much more curated group than what you typically see in growth equity, but that's appended to the largest base of operating resources that's afforded by having nearly $550 billion of capital. So it allows us to amortize at a much larger base, but apply those resources to a smaller group. So for example, we procure on behalf of hundreds of thousands of people. And in doing so, we save meaningful amounts that fall to the bottom line of our companies. We have an ability to cross-sell within our ecosystem. We're the largest owners of real estate in the world. And so to the extent that we look at a company, for example, we're the largest owners of e-commerce logistics assets. So we could look at an asset-light logistics company that can sit on top of our $40 billion estate of warehouses. It allows us to do things in ways that standalone growth equity and venture firms couldn't otherwise do. And so we really are looking for that synergy. Also, as a general matter, we tend to be the main, if not only, source of outside capital alongside the management team. So our level of influence is meaningfully greater than what the economic ownership would suggest it should otherwise be. And I think that's another way in which we can help add value in an aligned fashion with the management teams.
Yeah. All those warehouses seem to have been a very good purchase for some time. John, I'm curious, what do you typically see as sort of the hold period for you? What do you go in expecting that you will be a significant investor in terms of time period?
Yeah, we don't go in with any preconceived notion of what it needs to be in order to accommodate fundraising timelines. And we've always believed that to build a company of significance, you really do have to take an extended horizon, especially in the growth area, where the worst thing we can be doing is to introduce arbitrary fundraising cycles that can amplify inherent industry cycles. And I think in doing so, hamstring a management team's ability to make the substantive investments in their company that are requisite for leadership in 5 or 10 years. And so we go in with a very long-term horizon. But I'd say an average investment for us would be about 5 years on a capital-weighted basis.